This is a company's debt to equity ratio, and this number could be the difference between striking gold or losing it all in the stock market. Stay tuned as I revealed how to use the debt to equity ratio to find out if a particular company is a riskier bet than you thought. Imagine you're weighing two vital aspects of a company's finances. On one side, all the money it owes, and in the other, what it actually owns. The debt to equity ratio helps us balance both of these out. And if you're wondering how I got the balance sheet in that format, this is exactly what I did. The formula is simple: total liabilities divided by the total shareholders' equity. But there's more to it than meets the eye. Higher debt may mean higher risk. Could Apple be over leveraged, or is it smartly fueling its growth? This is where your detective work begins. Consider Apple. In 2023, the company had short-term debt of $15 billion, long-term debt of $95 billion, and total stockholders' equity of $62 billion. Therefore, the debt to equity would be calculated as follows. We take this plus the long-term debt divided by the total stockholders' equity. And this gives us a number of 179. This is close to a 2-to-1 ratio. Higher debt may mean higher risk. Could Apple be over leveraged, or is it smartly fueling its growth? This is where your detective work begins. A high ratio can be normal for some industries, while a red flag for others. In this case, for Apple, relative to its competitors, you can see that the company is using a high range, meaning a high range of debt relative to the equity of the company. However, it still looks like it's within a healthy range, so there's not much to be concerned about. Typically, a number less than 1 is considered very safe. 1 to 2 could be okay, but once you pass the 2 threshold, that's when things start to get a little bit more risky. As you saw from the calculation, in the case of Apple, a number of 175 means that roughly for every dollar in equity that the company owns, the company uses $2 of debt to manage its business. Armed with this knowledge, you're now better equipped to assess the financial health of any potential investment. But remember, no ratio tells the whole story of a company. If you've enjoyed this video, make sure to subscribe and turn on the notification zone so that way you get notified every time we create new videos like this that are going to allow you to take your investing game to the next level. Until the next one, invest wisely.